welcome to the Money Show, the show that puts your money matters front and center. In a world full of financial noise, we are here to bring you clarity, confidence, and control over your personal finances. Whether you are planning for retirement, building a portfolio, navigating debt, or just trying to make smarter money decisions, this is your space, your guide, and your daily check-in with your wallet. Every evening, we bring you insights from top financial experts, decode the latest trends, and answer your burning questions on saving, investing, spending, and everything in between. Because you're on the Money Show, we believe one thing: you don't have to be a finance expert to take charge of your money. You just need the right advice. I'm Kavita Thaplial, and let's begin the show. In a significant move this morning, the Reserve Bank of India's Monetary Policy Committee unanimously voted to cut out the repo rate by 25 basis points to 5.25% while maintaining a neutral stance. Now, this decision comes at a time when inflation has dropped sharply, domestic growth remains robust, and the rupee has weakened past 90 to the US dollar, raising external stability concerns. But according to Governor Sanjay Malhotra, the headroom created by the inflation outlook allowed the RBI to begin easing rates without jeopardizing macroeconomic stability. That's right. Now, why the rate cut? Now, CPI inflation for FY26 has been slashed to 2%, far below the RBI's comfort threshold. Some of this moderation, the governor said, reflects a sharp fall in food prices, and underlying inflation is seen lower once precious metals price effects are excluded. Now, with inflation benign and growth momentum intact, the MPC judged the monetary conditions could be eased to support productive sectors. Let's talk about the growth picture. The RBI remains upbeat on India's growth trajectory. GDP expanded 8.2% in Q2, powered by festive season consumption and GST rationalization. The FY26 growth forecast has been revised upward to 7.3%. Investment activity is improving, rural demand is healthy, and service continue to expand steadily. External sectors and liquidity. Let's talk about that. The governor highlighted the resilience of the external sector. Forest reserves have risen to USD 686 billion, offering more than 11 months to import cover. Now, to ensure liquidity remains comfortable, the RBI announced OMO purchase of 1 lakh crores and a 3-year USD INR buy-sell swap worth $5 billion this month. Now, transmission already visible. The RBI noted that lending rates on outstanding rupee loans have eased by 63 bips, while deposit rates on fresh term deposits have fallen by 105 bips, signaling a broad-based transmission of earlier policy moves. What's the bigger picture and what's the bigger message for you? Today's announcement signals the start of a measured easing cycle, with the governor hinting at the possibility of more cuts if conditions permit. Now, economists expects the terminal rate to settle near 5%, followed by a long pause. Now, despite global uncertainty, the RBI's message is clear. India is in a rare Goldilocks moment. Low inflation, strong growth, and a resilient external sector, allowing monetary policy to shift its focus towards supporting economic expansion while safeguarding stability. But now let's discuss all of this and understand this policy stance impact on your investment portfolio and your EMI burden. Definitely. I am joined by Puneet Pal, the head of fixed income PGI mutual fund, Pankaj Bansal, chief business officer, bankbazaar.com. Hi, evening, and welcome both of you on this very special edition of the Money Show today. Puneet, I'll come to you first because the RBI cut, the repo rate by 25 basis point that we're looking at. It's a unanimous decision, keeping its stance neutral by signaling a dovish bias given the growth-led uncertainty. The central bank revises FY26 CPI forecast sharply lower to 2% and expects the inflation in the first half of next year to remain at or just under 4%. Now, to support growth and ensure liquidity, RBI also announced 1 lakh crore of bond purchases, at a $5 billion 3-year FX swap. Together, these measures are growth supportive, Puneet, and the evolving growth inflation mix keeps the door open for one more rate cut. Financial conditions, if we talk about, should therefore be supportive for rate transmission for bond market settlement also. But Puneet, how do you like to decode this for our investors, and how should one understand this from an investment standpoint?
Sure. Thank you, first of all, for having me here. As you rightly put it across, that this policy is quite dovish. Going into the policy, the markets for the bond markets are quite divided whether the RBI will cut rates in light of the strong GDP growth that we saw and the rupee depreciation that we saw in the last 1 week, which created a bout of uncertainty in markets' mind whether RBI will really go ahead with a rate cut or not. But I think putting, everything clear in a very, everything clear in a context that RBI is looking at inflation. They are a formally inflation targeting central bank. They have given priority to inflation, and at the same time, they have said that they don't see any macroeconomic imbalances as of now. They have reduced the policy rates and also announced liquidity infusion measures, as you said, 1 lakh crore more plus a $5 billion of USD INR buy-sell swap. So what they intend to do is that to support growth, which is likely to slow down in the next half, as the governor also pointed out, the MPC also pointed out in his statement that next half they're expecting the growth to slow down. And also the fact that they want transmission rates, or the transmission of the policy rate reduction to happen quickly. That's why the liquidity infusion. So all this makes up for a dovish surprise for the bond markets. Bond yields have already come down a bit, and we expect them to come down further. We expect the 10-year benchmark to go towards 630 or 635 over the course of the next couple of months. In terms of investment, I will say that we think that short duration corporate bond funds, medium duration corporate bond funds are the best bet right now because they offer a decent risk reward opportunity for the investors currently. Given the fact that we don't see a rate hike at the horizon, probably we think that this probably was the last rate cut, though as you said, some economists are predicting one more rate cut, but we are of the view that this probably is the last rate cut in this rate cutting cycle. But it will be a long pause after this, and coupled with the fact that RBI is quite keen to ensure adequate durable liquidity in the system, which was reiterated by the RBI governor in his statement today. We think that corporate bond funds, both short duration and medium duration, are the best bet for debt investors right now.
Sure. We'll talk on that more, but then yes, as highlighted by you, this looks like, according to you, this looks like the last rate cut and a longer pause after that. So Pankaj, now here's the work for you. For someone who's waiting for a deeper relief on the EMI front, now how good is this good news here, and how would you like to explain this to our viewers who are just waiting for that huge EMI relief?
No, absolutely. I think this has been a very positive news for the consumer standpoint. If you look at the last 1 year, about 125 basis points cut. And if I have to put it in a number perspective, very simply, I'll just give an example for the consumers here. Assume if I take a home loan of just 50 lakh rupees for 20 years, my normal EMI at 8.5% was 43,000 rupees per month, broadly, right? For 20 months tenure. Now, after this rate cut, what has happened? I'll tell you the difference. If I still pay the same EMI, about 43,300 rupees for this 50 lakh loan for 20 years, my interest saving, maybe before this thing when we started was about, 9 lakhs. Now it's about 18 lakhs if I don't cut the EMI. If I cut the EMI by 4,000 rupees in the last 125 basis points, then it will be like 9 lakh rupees. So assuming I don't change an EMI, I'll tell all my viewers and all my this thing, always never ever cut down your EMI, just cut down your tenures, which will automatically will happen. So I'll still will say that, continue that strategy and you will save 8 lakh rupees in the last 125 basis point cut that RBI has done only on interest that you are paying for 20 years on the home loan of 50 lakhs. So that is one thing. Second, obviously, from a consumer demand perspective, even the new rates, which was about hovering about 8.5% with a 2.5% kind of margin being built in, we are expecting that the rates will be around 7.8 to 7.9% going forward for the consumers for the new loans as well. And it's a very strong wicket because your real estate sector, because of the consumption-driven economy that Mr. Malhotra has been talking about, it's more of a investment-driven, I would say, monetary policy rather than a saver-driven. So you, as you rightly said, the saving rates have cut down, like FD rates have come down close to 100 basis points, plus minus 5 basis points for people. But for EMIs, it's a 125 basis points cut in the last 1 year itself. And I rightly said, if even stay here, it's a magical move for a lot of consumers, Kavita, on our side, in terms of the interest saving they make on with a positive environment and the positive economy that we are moving on the growth trajectory.
I think with that, it's a wrap on this particular edition of Money Show, where we were trying to help our viewers understand the implication and the benefits on their investments, or the way they want to strategize their EMIs going ahead. Thank you so much, both of you, for being on the show. And it's time for a short break, but then post that, let's focus on your portfolio queries. Just in case you have anything to send across, the WhatsApp number is flashing on the screen. Do it over there, and you can also email us your queries. See you after this break.